JP Morgan Chase just released some shocking news that's extremely bullish for crypto and XRP. And what they shared speaks to the volume and demand they're probably experiencing from all of their retail customers and clients. What's interesting is that this is a complete 180 from what the CEO Jamie Dimon shared 7 years ago. In other words, this is no small development, as JP Morgan Chase is literally the biggest bank in the United States and is arguably one of the most influential players that has the power to lobby and influence Congress for reforms that positively benefit their crypto business. So in this video, we'll be sharing the pivotal news surrounding JP Morgan's crypto 180-degree turn. We'll be sharing a bit of info on the current state of the markets and whether or not they signal a recession sooner rather than later. We'll be sharing some breaking news that just came out yesterday surrounding the SEC lawsuit and how a potential last-minute appeal is now on the table. And by the end of this video, we'll be covering the price action so you have a solid understanding of what's going on with XRP, some potential targets, and buy zones. This is something that we wish we didn't have to cover, but if we don't cover it, you're not in the know. So that said, the SEC is probably going to appeal the XRP's programmatic sales ruling in the Ripple case, as Fox Business journalist Eleanor Tourette took her to her handle X and revealed that a former SEC lawyer who recently left the agency, so now I'm assuming he can talk a little, says that the SEC will probably appeal Judge Torres's July 2023 ruling. In other words, they might not appeal, or they're not likely to appeal, the $125 million settlement, but they are going to appeal the July 2023 ruling on XRP's programmatic sales in the Ripple case. Now, this did not involve selling to retail investors through exchanges. This was to bigger investors, even though the bigger investors had experienced no financial harm. According to him, many at the SEC believe the ruling is wrong, bad law, and should be appealed, to which Jeremy Hogan, another attorney, basically stated, of course they think the opinion is wrong. They were on the losing side. What the SEC should be thinking of right now is whether an appeal furthers its mandate of investor protection and capital formation. Why isn't that the top of mind? More evidence the SEC has lost the plot. However, at the end of the day, it doesn't look like a strong case for the SEC, as John Deaton, who is currently running for Senate against Elizabeth Warren, and a lawyer, basically stated that even if they did appeal, it's likely they're going to face another court defeat. Now, basically what he's saying is that there are all three factors of the Howey test. However, most people might consider it four factors, considering one of the factors is two-pronged, in which case he said, I don't believe an appellate court will rule Judge Torres was in error applying the third prong. Judge Torres made her ruling very specific. So this would basically make it so the case would go back to Judge Torres for her to apply the common enterprise prong, or another prong inside of one of those factors, and she would likely rule the SEC didn't establish a common enterprise. If that happened, the SEC would lose again and have to appeal all over. To which John Deaton on Twitter basically said it makes no sense and would be a total waste of taxpayer money to appeal this decision, which is why someone like Gary Gensler might just appeal. To which the chief legal officer, Stuart Alderodi, over at Ripple said 4 out of 5 dentists recommend sugarless gum for their patients who chew gum. And 4 out of 5 SEC commissioners agree with the VP Harris that the US should support innovative technologies like digital assets. And here is a Representative Wiley Nickel from North Carolina's 13th district. And here he even said, the SEC Gov's hostility towards digital assets has hurt consumers, set the US behind the rest of the world, and damaged the Biden-Harris administration. Gary Gensler's weak defense of his war on Web3 is as flawed as his leadership. So even his own are turning against him. Whether or not he appealed the Ripple case back in 2023 at this point doesn't even really matter, considering nobody is on his side anymore. Now let's move on to a bit of the macro, as stocks are poised for something that hasn't happened since the days of the dot-com bubble, 1999, 2000. And in this article, they state that the S&P 500 is flirting with what could be a rare accomplishment, rising 20% or more during 2 consecutive consecutive calendar years. So imagine each year we see a monumental rise of 20%, which is actually insane considering the average S&P 500 index return would be about 9.5 to 11.5% in any given year. This is almost like taking your gains that you would have made in 4 years and condensing them into 2, as the index rose for the 41st record close of its year. Now, this is very similar to 1995 to 1999 because in those days, burgeoning public enthusiasm for stock trading and the hype unleashed by the advent of commercial internet helped the S&P 500 appreciate by 20% or more for 4 straight years, beginning in 1995. That is absolutely insane, and many people believe this is because of the new technologies, arguably AI, and then, of course, crypto, but that's in its own market sector. But what I find most interesting is that based on where stocks are trading relative to company sales, the S&P 500 is even more expensive today than it was back then. FactSet data showed. The forward price to sales ratio for the S&P 500 stood at 2.9 times at the end of August compared to 2.4 times in late 1999 before the bubble burst. But, and here's the key difference, the biggest American companies of today are also more profitable than they were back then, and we could argue that's probably because of technological factors. It doesn't cost as much to run a company. When you think about the Industrial Revolution, right, creating steel is a lot more expensive than creating software that can service thousands of people by a single developer. That said, earlier this month, a couple of analysts at JP Morgan Securities warned that based on their models, the S&P 500 would see its average return over the coming decade shrink to only 5.7% per year. That's lower than the average annual return of 8.5% for the S&P 500 since it was introduced in 1957. Now for the big news from JP Morgan Chase, which ranks at number 1 in terms of U.S. banks, ahead of Bank of America, Wells Fargo, Citi, and you name it. It has the most assets under management and adheres to very strict regulatory guidelines. But I would argue they also have the advantage of creating a lot of these regulatory guidelines, considering they are the biggest gorilla in the room. And so yes, they're going to be sitting in the right rooms with the right people from Congress. So when they share something as pivotal as this, it is very, very big news for crypto and XRP. As JP Morgan states that cryptocurrencies are now its preferred alternative asset class. Think about that for a second. It's not just an alternative asset class for them, it is the preferred one. As JP Morgan CEO Jamie Dimon has not been shy in his negative criticisms of Bitcoin and digital assets, going as far as calling Bitcoin a fraud in 2017 and also stating that it was worthless. It really starts to make you wonder if he knew what a lot of people didn't back then, unless of course you've been involved in this community and watching this channel for quite some time now. Back in 2017, it was quite small as an asset class, and a lot of these big players want to position themselves. So the way that you do that, right, is by telling everyone in the world this is crap, it's a scam, you're gonna get screwed, it's worthless, and then you start to position and load up as the big banks do, and then you start to change your tune. And that's exactly what Jamie Dimon did, as he said he'd fire in a second anyone caught trading Bitcoin when it was at $4,000. Could you imagine loading up on Bitcoin even at $4,000? Do you know what XRP was? Probably pretty dang low. 7 years later, the investment bank holds positions in spot ETFs tracking the Apex crypto. Well, in a note published to people, the bank said that cryptocurrencies had surpassed even real estate as one of its favored alternative assets. Now, many might wonder, how is that even possible? Real estate is a far bigger market, but it also means that it's older and it's probably likely more tapped out. There's less gains there. So if I'm picking an alternative asset that's far more liquid, I would argue crypto is that asset. But it really helps to have someone like JP Morgan confirming that, as alternative assets mean investments that do not fit into the conventional categories like stocks or bonds. Thus, we replace real estate with digital assets as our preferred alternative asset class, along with hedge funds. So whatever the case may be, it seems markets are already pricing in a potential appeal. And as the dot-com craze went, we might still have a strong end to the year and a strong start to the next year. Then it remains to be seen what happens in May. As the old phrase goes, sell in May and look away. But I thoroughly expect markets to continue to rally as more and more big players are entering the crypto space, as XRP is finally at the last leg of this whole regulatory corruption. And so we're at a point where even the SEC is turning against Gary Gensler, as they want no part in it. And arguably it helps their careers move forward as a new administration likely comes in and changes the ballpark. That said, XRP, since its pump back in July, I don't know, 15th through the 29th, has looked relatively flat. It does not look weak, however, as right here we have a blue line that's a 10 EMA, and this yellow line is a 20 EMA. And whenever they cross over and we hang out above this range, that is a good indicator that we are on the upside. And what's even a better indicator is the fact that we have a series of higher lows, one right here, here, and here. So as long as we maintain this range and support, as long as these do not cross back over, as long as volume continues to decline into this range right up here at 62 cents, we're totally fine. What I would like to see is volume increase on a breakout. Whether the breakout comes right here at about 62 to 64 cents, or we break above this range right here, and this green line for this pennant or triangle. That said, we are expecting some explosive moves to the upside on a break above the 62 to 74 cent range, because this is really going to be the range to be. And so what I'm going to do is I'm going to take this tool right here and draw a box. If we break out above this range from 62, and I know that's pretty high, but realistically it's going to be about 75 cents considering we go to the daily time frame. That's where a lot of the price action has traded. When you pull up that VRVP, there really isn't that much resistance above this range right here. As you can see, we have the majority of volume traded between 63 cents all the way down to 37 cents for the last couple of years. And when we look at the past 6 years, the majority of volume is traded between 20 cents up to 30 cents. So that said, I'm looking at a lot of volume on the Binance chart, because this chart has, quite a bit of trade action and volume. I mean, we break out above here, I think it's smooth sailing straight up to at least $2. Then it remains to be seen if we see a new all-time high. So that said, subscribe to Bullrunners. Look forward to seeing you on the other side. If you enjoyed the video, if you learned something new, subscribe to the channel, and I look forward to seeing you in the next video, my friend. Goodbye.